If you have excess cash, there are strategies you can employ that can help make your cash work harder for you than just sitting around in a bank account. Defensive investments. These are strategies that allows the investor to stay in the market with the potential to earn a return higher than either the high yield savings account or the money market fund that we've just discussed, and still reducing volatility within the portfolio. These types of investments include high quality investment grade corporate bonds, government treasuries, bonds and notes, large cap value stocks, private equity, and private debt. These types of strategies are good for investors who want to stay in the market but don't want to give up the potential to continue to capture upside growth potential of the equity market. So they still want to stay in there ready for when the market starts to rebound and volatility starts to decrease. And then once that volatility does subside, the investor then redeploys back into those riskier assets. High quality bonds, specifically S&P grades AAA and AA, offer the greatest protection of loss when compared to other lower credit quality bonds, while still earning some amount of return via bond interest payments and a potential for some market appreciation. These companies have extremely strong or very strong capacities to meet their financial obligations. Government treasuries earn more interest in a high yield savings account or a money market fund, and the interest earned is based on the maturity of the treasury asset. Typically, longer maturity bonds will pay higher interest than shorter term treasury notes or bills. However, depending on your particular time frame, a short or medium term instrument may be a better fit than a long-term bond. Large cap value stocks. These are very similar to high quality bonds, and they are invested in companies that have the financial strength and flexibility to ride out challenging environments. These large cap value stocks regularly pay dividends, which help to offset the relatively low growth in the stock price when compared to their growth stock brethren. You can think Chevron versus NVIDIA. And private equity and private debt assets, these are investment vehicles that have become more available to the larger general investing public. However, an investor must meet the accredited investor definition. An accredited investor in private equity or private debt must make either $200,000 per year for 2 years, $300,000 if you're married filing joint, or have $1 million in net worth, not including the value of your primary home. Now, these investments carry the most risk of all the strategies we've discussed so far today, and they generally have restrictions on withdrawals. However, these investments have low correlation to broader equity markets. And what this means is that while private credit and private equity both rise and fall with the broader market, they do so but to a smaller extent. So having these assets as part of an overall defensive portfolio can help reduce portfolio volatility while still enabling positive returns. The underlying thought behind all of these strategies is that they are short to medium term in nature. We strongly recommend that you work closely with your advisor and craft a strategy that is flexible and resilient, but can also meet the limit.